5 commodity funds, one morning, all frozen. On Friday, January 30th, 2026, Chinese regulators did something they almost never do. They hit the emergency brake on 5 separate investment funds at the exact same time. No warning for the people who'd bought in, no grace period, just silence. If you owned shares in the UBS SDIC Silver Futures Fund, you woke up Friday morning unable to trade, locked out. Meanwhile, Citigroup was telling the world that silver was headed to $150 per ounce within 3 months. So here's the question that should make your stomach drop. If silver is about to explode upward, why did China stop its own citizens from buying it? The answer isn't what you think. China didn't freeze these funds because silver was going to crash. They froze them because of what happens when millions of people rush through the same door at once. And what Chinese regulators know that most investors don't is that markets don't collapse when prices rise. They collapse when behavior becomes uncontrollable. Stay with me, because by the end of this, you'll understand why this freeze wasn't about protecting you from losses, it was about protecting the system from you. Part 1. How a Mania is Born. Let's start with something most people outside China have never heard of. A listed open-ended fund, or LOF. Think of it as a hybrid investment vehicle that trades on the stock exchange like a regular stock, but it's actually a fund that holds other assets. In China, LOFs have become one of the few legal ways for regular retail investors to get exposure to commodities like oil, gold, and silver without actually buying the physical metal or trading futures contracts themselves. Now here's where the structural problem begins. In most developed markets, if you want to invest in silver, you've got options. You can buy physical silver bars. You can trade silver futures. You can invest in mining company stocks. You can buy international ETFs that track silver prices. But in China, the government tightly controls what investment channels are available to ordinary citizens. Capital controls mean you can't just move your money offshore to buy international ETFs. Futures trading requires special permissions and higher account minimums. Physical precious metals come with storage issues and authenticity concerns. So when the UBS SDIC Silver Futures Fund launched as China's only public fund with direct exposure to silver futures contracts, it became something rare and valuable. The only door in the room. This fund, trading under the ticker 161226.SZ on the Shenzhen Stock Exchange, wasn't just another investment option. For millions of Chinese retail investors, it was the only option. That's a structural monopoly created not by the fund itself, but by regulatory scarcity. This matters because of a basic principle of human behavior. When you have one door and a growing crowd, pressure builds, and that pressure was building against a backdrop that made silver look irresistible. Throughout 2025 and into early 2026, global silver prices had been climbing steadily. Geopolitical tensions were escalating. Supply chain disruptions continued from previous years. Industrial demand for silver, particularly from solar panel manufacturing and electronics, was hitting new highs. China itself had imposed export restrictions on certain metals, further tightening global supply. And then there's silver's unique personality as a commodity. Unlike gold, which is primarily a store of value and moves relatively slowly, silver is volatile. It's got industrial uses that make it sensitive to economic cycles. It's got a smaller market than gold, which means price swings can be more dramatic. Traders describe silver as gold on steroids. When gold moves 5%, silver might move 15%. That volatility attracts a certain kind of investor, the momentum trader, the trend follower, the person who wants to catch the rocket ship before it leaves the atmosphere. So picture the setup. Chinese retail investors with limited alternatives, watching global silver prices climb week after week, seeing industrial demand surge, hearing analysts talk about supply constraints, and they've got exactly one vehicle they can legally use to participate, the UBS SDIC Silver Futures Fund. Every investor who wanted silver exposure had to funnel through that same narrow channel. And here's the thing about narrow channels, they create pressure differentials. When too many people want to get through the same door, they start pushing. They start paying more just for the privilege of getting in. And that's exactly what happened. This wasn't a gradual organic price discovery. This was a crowd forming at the only entrance, willing to pay whatever it took to get inside. The question nobody was asking in the moment, but should have been, was simple. What happens when too many people rush the same narrow exit? Because in markets, every entrance is eventually an exit, and the people pushing hardest to get in rarely think about how they'll get out. That pressure was about to reveal itself in the most obvious way possible, through price. Part 2. The 36% warning signal. Let me explain something that sounds technical but is actually pretty straightforward. A premium. When you buy shares of the UBS SDIC Silver Futures Fund on the exchange, you're buying units that represent ownership of underlying silver futures contracts. Those futures contracts trade on the Shanghai Futures Exchange at a certain price. Under normal circumstances, the fund's share price and the value of those underlying contracts should move roughly in sync. Maybe there's a small gap of 1 or 2% due to trading costs or timing differences, but they should track each other. By late January 2026, the UBS SDIC Silver Futures Fund was trading at a 36% premium over the actual value of the silver contracts it held. Let that sink in. Investors were paying nearly 40% more than the underlying asset was worth. If the silver contracts were worth $100, people were paying $136 for exposure to those same contracts through the fund. This is like paying $14 for a $10 bill. It makes no rational sense, which is exactly why it's such a powerful warning signal. In efficient markets, premiums like this get corrected almost immediately through arbitrage. Sophisticated traders see the gap, buy the cheaper asset, sell the expensive one, and pocket the difference. The gap closes, equilibrium restores. But that correction wasn't happening. The premium kept growing, and the reason tells you everything about what kind of market this had become. The buyers flooding into the UBS SDIC Silver Futures Fund weren't sophisticated arbitrageurs analyzing value discrepancies. They were retail investors following momentum fueled by social media hype, chasing a trend they believed would continue indefinitely upward. On Chinese social media platforms, particularly Xiaohongshu, which some of you might know as RedNote, silver investing had become a viral topic. People were posting screenshots of their gains. Influencers were talking about silver as the next big thing. The narrative was simple and seductive. Global prices are rising, supply is limited, industrial demand is surging. This is your chance to get rich. The fact that they were paying a 36% premium didn't matter to them because they believed the underlying asset was going up 50%, 100%, maybe more. This is trend-following behavior at its purest. Buy because it's going up. It's going up because people are buying. People are buying because it's going up. The logic is circular, self-reinforcing, and completely detached from fundamental value. And when enough people engage in this behavior simultaneously, through the same narrow channel, the price distortion becomes extreme. Fund managers knew this was unsustainable. They issued repeated risk warnings throughout late 2025 and early 2026. They published notices saying the premium was too high. They tried to turn away new investors. They temporarily halted new subscriptions. None of it worked. The crowd kept pushing. Here's what makes this particularly dangerous. Premiums don't stay inflated forever. Eventually, reality asserts itself. Maybe the underlying price stops going up. Maybe new supply enters the market. Maybe some external shock changes the narrative. Maybe people just decide to take profits. Whatever the trigger, when a premium collapses, it collapses fast. And if you paid $136 for something worth $100 and the premium disappears, you've just lost 26% of your money even if the underlying asset hasn't moved at all. The fund managers understood this. The regulators understood this. The question was whether the crowd understood this, or whether they were too caught up in the momentum to care. And the answer became clear. They didn't care, or they didn't understand, or they understood but believed they'd get out before everyone else. This wasn't a market discovering the true value of silver through informed price signals. This was a distortion, a mania, a collective detachment from the thing prices are supposed to represent. The market wasn't rising, it was breaking, and breakage, in financial systems, doesn't stay contained. It spreads. So when Chinese regulators looked at that 36% premium, they weren't seeing optimism. They were seeing instability hiding inside optimism, and they made a decision. Part 3. The morning China pulled the plug. Friday, January 30th, 2026. Markets opened in Shanghai and Shenzhen at 9:30 a.m. local time. Investors who owned shares in the UBS SDIC Silver Futures Fund tried to trade, and they couldn't. Full-day suspension. The entire fund was frozen. No buying, no selling, just a halt notice on their screens. This was the second full-day suspension since January 22nd. 8 days earlier, regulators had done the same thing, frozen the fund for an entire trading day. That should have been the warning. That should have been the moment investors stepped back and asked what was happening. Instead, many saw it as a temporary inconvenience, a minor obstacle before the next leg up. When trading resumed after that first freeze, the premium stayed elevated. The crowd came back, but this second freeze came with company. 4 other commodity funds were hit with suspensions the same morning: the Harvest Crude Oil Fund, the GF Oil Exploration Fund, the China Southern Crude Oil Fund, and the Huan Oil Fund. These were all listed open-ended funds focused on oil exposure. Their suspensions were shorter, just 1 hour until 10:30 a.m. Beijing time. But the message was the same. Regulators were stepping in. Now notice the difference in treatment. Oil funds got 1-hour pauses. The silver fund got a full-day halt. That tells you something about the severity regulators assigned to each situation. Oil had its own speculative interest, but silver was the acute problem. Silver was the fund trading at absurd premiums driven by social media-fueled mania. Silver was where the systemic risk was concentrated. And here's what's crucial to understand. This wasn't a response to a market crash. Silver prices globally were still elevated. The fund hadn't collapsed. There was no external trigger like a geopolitical event or a major seller entering the market. The freeze came while things still looked good on the surface. That's what makes it so telling. Regulators didn't wait for the crisis. They intervened to prevent the crisis. Full-day trading suspensions are rare in Chinese markets. They're reserved for situations where regulators believe continuing to trade would pose unacceptable risks. The official explanation, pulled from regulatory notices and analyst reports, was clear. Preserve capital market stability. Protect retail investors from potential huge losses if conditions abruptly reverse, and reduce underlying systemic risks. Break that down. Preserve capital market stability means they're worried about contagion. If the silver fund premium collapses and retail investors take massive losses, does that panic spread to other commodity funds? Do people start pulling money out of other LOFs? Does it create broader instability in the exchange-traded fund ecosystem? Protect retail investors from huge losses means regulators see the people in this trade as unsophisticated and vulnerable. These aren't hedge funds with risk management teams. These are individual investors who saw silver going up on social media and wanted in. Many of them don't understand what a 36% premium means. Many of them don't have stop losses or exit strategies. They're the kind of investors who buy high and panic sell low, locking in catastrophic losses. Reduce underlying systemic risks is the big one. This language suggests regulators see connections between this fund and broader financial stability. Maybe it's banks that lent money to investors to buy the fund. Maybe it's the concentration of retail capital in a single illiquid vehicle. Maybe it's the ripple effect into industrial supply chains if silver prices spike or crash unpredictably. The freeze wasn't about today's price. It was about tomorrow's fallout. It was about what happens when the premium snaps back, when momentum reverses, when the crowd that paid $136 for a $100 asset realizes they're trapped. And in a market with only one door, being trapped means something very specific. You can't get out without driving the price down further, which means everyone trying to exit at once creates a self-reinforcing collapse. China pulled the plug before that happened. They chose stability over freedom. They chose control over market discovery. And whether you think that's authoritarian overreach or prudent regulation, it reveals something important. They knew the mania couldn't sustain itself, and they decided the cost of intervention was lower than the cost of collapse. Part 4. The $150 Silver Paradox. Now here's where it gets interesting, and where a lot of people get confused. On the same week that China froze its silver fund to prevent speculative losses, Citigroup analysts published a forecast saying silver could hit $150 per ounce within 3 months. So which is it? Is silver going to the moon, or is it a dangerous bubble about to pop? The answer is both. And neither, and that's the paradox. Let's start with what Citigroup actually said. Their projection was based on short-term momentum. They observed that Chinese retail investors, like traders in US futures and derivatives markets, tend to be trend-following. They saw strong buying continuing, driven by what they called robust short-term momentum. The forecast to $150 wasn't based on fundamental supply-demand analysis or long-term industrial trends. It was based on the observation that when momentum is this strong, it can carry prices much higher before it exhausts itself. This is a momentum-based projection. It's saying, if current behavior continues, here's where the math takes us. It's not saying that behavior will continue, or that $150 represents fair value, or that silver is worth that much based on industrial demand or scarcity. It's a conditional forecast. Given this momentum, expect this outcome. And here's the critical insight. Strong short-term momentum can absolutely coexist with structural fragility. In fact, they often do. The strongest momentum often appears right before the most violent reversals. Think about any bubble in history: tulip mania, the dot-com bubble, the housing crisis. Bitcoin in late 2017. The most extreme price acceleration happened in the final stages, right before the collapse. Momentum and fragility aren't opposites, they're companions. So Citigroup saying silver could hit 150 doesn't contradict China's decision to freeze the fund. It actually supports it. Regulators looked at the same momentum Citigroup was analyzing and said, this is unsustainable, and when it reverses, our retail investors are going to get destroyed. Better to pause now than to let them chase it higher and lose even more. There's another piece to this puzzle. ETF, withdrawals. Globally, investors had been pulling money out of silver-backed exchange-traded funds even as prices climbed. Normally, ETF flows are a good indicator of institutional sentiment. When big money is leaving, it's often a warning sign. But in this case, ETF withdrawals didn't stop silver's rise. Why? Because the buying pressure from Chinese retail investors, concentrated through that single fund and paying massive premiums, was overwhelming the selling pressure from institutional ETF redemptions. This tells you the rally was driven by a specific localized cohort of buyers with a specific psychology, trend-following retail momentum traders with limited alternatives and high conviction. That's not a stable foundation. That's a crowd that can reverse just as quickly as it formed. Now let's engage in some clearly labeled speculation here, because we can't know exactly what Chinese regulators were thinking. But it's plausible that they view extreme bullishness itself as a destabilizing force. Not because high prices are bad, but because parabolic moves driven by concentrated retail speculation create conditions for equally parabolic crashes. And crashes, especially ones that wipe out retail investors en masse, create political problems, social unrest, and loss of confidence in financial markets. China's regulatory philosophy prioritizes stability over explosive growth. They'd rather have steady, controlled appreciation than a spike that attracts unsophisticated money and then collapses. The freeze wasn't a bet against silver reaching $150. It was a bet against the crowd psychology that would form around that journey. Reframe it this way. China didn't bet against silver. They bet against crowd psychology. They looked at millions of retail investors paying 40% premiums to chase a momentum trade, and they said, no, we're not letting this play out to its natural conclusion because the natural conclusion involves those people losing their savings. So the paradox resolves like this. Silver might very well hit $150 based on momentum, and that's precisely why China froze the fund, because momentum-driven rallies end badly for the last people in, and in a market with only one door, almost everyone is the last person in. Part 5. Who gets hurt when metals break? Let's shift focus from charts and premiums to the actual human beings affected when commodity markets go haywire. Because the real cost of a silver mania isn't measured in percentage points. It's measured in ruined retirements, unpayable debts, and supply chain chaos that touches people who never bought a single share. Start with the retail investors. These are the trend followers who saw silver going up, heard about it on social media, believed the hype, and put their savings into the UBS SDIC Silver Futures Fund. Many of them don't have diversified portfolios, they're not wealthy. They're middle-class workers who see investing as a way to get ahead. To build wealth their salaries alone won't provide. When they pay a 36% premium without understanding what that means, they're not being stupid. They're being human. They're following the crowd, trusting the momentum, believing the story they're being sold. When that premium collapses, these people don't just lose money. They lose belief in the system. They become skeptical of markets, of regulators, of financial institutions. That erosion of trust has long-term consequences for capital formation and economic participation. And in China's case, where social stability is a paramount concern for the government, Mass retail investor losses can quickly become political problems. But it's not just the investors. Extreme volatility in silver prices creates real problems in the physical economy. Silver isn't just a speculative asset, it's an industrial input. It goes into electronics, solar panels, medical equipment, batteries, photography, water purification systems. Manufacturing supply chains depend on relatively stable, predictable pricing for these inputs, so they can plan production, set prices, and manage costs. When silver prices spike from speculation rather than actual supply-demand fundamentals, it creates artificial cost pressures. A solar panel manufacturer in Jiangsu province has to pay inflated prices for silver paste used in photovoltaic cells. Those costs get passed down the chain. Either the manufacturer eats the cost and loses margin, or they raise prices and make solar installations more expensive, which slows renewable energy adoption. Either way, the real economy suffers from financial market distortions. Electronics manufacturers face the same problem. Silver is used in circuit boards, switches, and conductors because of its excellent electrical conductivity. When prices are volatile and elevated, companies have to decide: do we absorb the cost, do we pass it to customers, or do we try to find substitutes that might be less effective but cheaper? None of these options are good. They all represent efficiency losses created by speculative excess. And here's the thing about industrial disruption. It hits workers. When a manufacturer's margins get squeezed by input cost volatility, they look for places to cut expenses. That means hiring freezes, reduced hours, sometimes layoffs. The factory worker assembling solar panels in Guangdong didn't buy silver futures. They don't know what a listed open-ended fund is, but they feel the consequences when commodity speculation distorts the supply chains their livelihood depends on. This is why China prioritizes predictability over price excitement. Western financial culture often celebrates volatility as opportunity. If you're a sophisticated trader, volatility means profit potential. But if you're running an industrial economy that employs hundreds of millions of people in manufacturing, volatility means chaos. It means uncertainty. It means costs you can't predict and margins you can't protect. The freeze of the silver fund wasn't primarily about protecting speculators from themselves. It was about protecting the broader system from the spillover effects of speculation. It was about preventing artificial price inflation driven by retail mania from disrupting industrial supply chains that actually need silver to function. Commodity chaos doesn't stay on trading screens. It reaches factories. It reaches workers. It reaches the small business owner who needs stable input costs to survive. And when regulators in China look at a 36% premium on a fund trading at record volumes, driven by social media hype, they don't just see potential investor losses. They see potential economic disruption that touches people who have no connection to financial markets. So who gets hurt when metals break? Everyone. The investors who bought high and will sell low. The manufacturers who can't plan around volatile input costs. The workers whose jobs depend on stable supply chains. The economy as a whole, which functions better when prices reflect actual scarcity rather than speculative fever. China looked at that cascade of potential harm and said, "We're stopping this now. Not because we're anti-market, because we understand that markets serve the real economy, not the other way around." Part 6. China knows something, and it's about control. So let's come back to the title. China knows something you don't. What exactly do they know? Here's what we can say with confidence based on the facts. Chinese regulators knew that retail speculation had completely detached from fundamental value. They knew that a 36% premium was mathematically unsustainable. They knew that structural limitations in domestic investment channels had created a dangerous concentration of speculative capital in a single fund. They knew that social media-driven momentum trading was attracting unsophisticated investors who didn't understand the risks they were taking. And they knew that when this premium inevitably collapsed, it would cause significant losses to retail investors and potentially destabilize broader market confidence. That's not speculation. That's visible in the data, the premium levels, the trading volumes, the risk warnings fund managers issued repeatedly. But there's a deeper level of knowledge here, and this is where we move into informed speculation. China may understand something about crowd psychology and systemic risk that Western financial regulators either don't grasp or don't have the political will to act on. They may know that allowing manias to run their course, while ideologically consistent with free market principles, creates preventable harm. They may know that retail investors, despite all the risk warnings and disclosures, will still chase momentum and lose money, and that those losses create social and political costs that outweigh the economic benefits of unrestricted trading. The freeze may serve as a pressure release valve. Let some steam out before the whole system blows. Stop the mania while losses are still moderate rather than catastrophic. Reset expectations. Cool the speculative fervor. Give people a chance to think rather than just react to momentum. This reflects a fundamentally different regulatory philosophy than what you see in the United States or Europe. Western regulators tend to focus on disclosure. Make sure investors are warned about risks, make sure information is available, and then let markets do what markets do. If people lose money despite the warnings, that's the price of market freedom. Chinese regulators don't accept that trade-off. They believe they have a responsibility to actively prevent foreseeable harm, even if it means limiting market freedom. They believe that when they can see a mania forming, see unsophisticated investors about to get hurt, and see potential spillover into the real economy, they should intervene. Not after the crash, but before it. You can agree or disagree with that philosophy, but you should understand what it reveals. China views financial markets as tools that serve state objectives and social stability, not as autonomous systems that should be allowed to self-regulate through boom and bust cycles. So let's revisit the opening mystery one more time. If silver is headed to $150, why did China stop people from buying it? Because the destination doesn't matter if the journey destroys people. Because a 36% premium means most of the buyers are already underwater before any crash even happens. Because concentrated speculation through a monopoly vehicle creates systemic risks that extend beyond individual investor losses. Because markets don't fail when prices rise. They fail when behavior becomes uncontrollable, and China decided that behavior had already crossed that line. The central takeaway isn't about whether China was right or wrong to freeze these funds. It's about understanding what the freeze reveals. Markets are not just mechanisms for price discovery. They're systems where human psychology, structural limitations, and regulatory philosophy collide. And when regulators conclude that the collision is about to cause serious damage, their response tells you what they value and what they fear. China values stability over explosive growth. They fear retail losses that erode confidence in markets and government. They fear industrial disruption from speculative commodity price spikes. They fear the social costs of financial manias that primarily harm unsophisticated investors. And they're willing to restrict market freedom to avoid those outcomes. Whether that makes them wise or authoritarian depends on your perspective, but it definitely means they're operating from a different playbook than most Western financial systems. So if this freeze was a warning, who was it really meant for? The obvious answer is retail investors. Stop chasing this trade, you're going to get hurt. But maybe the warning goes deeper. Maybe it's for anyone who believes momentum alone is a sufficient reason to invest. Maybe it's for anyone who thinks regulatory intervention is always wrong, regardless of the circumstances. Maybe it's for industrial economies that depend on stable commodity prices and can't afford speculation-driven chaos. Or maybe the warning is simply this. When you see a crowd rushing toward a single door, don't join them. Ask why there's only one door. Ask where the crowd is actually trying to go. Ask what happens when everyone tries to leave at once. Because that's what China knows that a lot of investors don't. The entrance is easy. It's the exit that kills you.